Ever wondered if there's a way to invest in exciting up-and-coming companies before they hit the big time and get some serious tax breaks for doing it? Well, there is, and it's called a venture capital trust, or VCT. Today, we're going to dive deep into what VCTs are, how they work, who they're for, and the incredible tax benefits they offer. But, and this is a big but, we'll also talk about the risks involved, because this isn't your average savings account. So, what exactly is a venture capital trust? Think of it as a special type of investment company listed on the London Stock Exchange. Its job is to pull money from investors like you and me, and then use that money to invest in a portfolio of small, young, and unlisted UK companies. These are the potential game changers, the innovators, the businesses with high growth potential that aren't yet household names. We're talking about sectors like technology, healthcare, and sustainable energy. The UK government created VCTs back in 1995 to encourage investment into these crucial early-stage businesses, which are vital for economic growth and job creation. By investing in a VCT, you're not just aiming for financial returns, you're actively helping to fuel the next generation of British enterprise. Now, let's get to the part that really turns heads: the tax incentives. These are designed to compensate investors for the higher risk they're taking on. First up is the big one: 30% upfront income tax relief. That's right. If you invest, say, £10,000 into a new VCT share issue, you can claim back £3,000 on your income tax bill for that year. The maximum you can invest and claim this relief on is £200,000 per tax year. The only catch is you have to hold your VCT shares for at least 5 years to keep that tax relief. If you sell before then, you'll have to pay it back. But the tax perks don't stop there. Any dividends you receive from your VCT shares are completely tax-free. This is fantastic because VCTs often aim to pay out regular dividends to their investors. And finally, when you eventually sell your VCT shares, any capital gains you make are also completely tax-free. So, to recap, 30% upfront tax relief, tax-free dividends, and no capital gains tax. You can see why they're so attractive, especially for higher-rate taxpayers who are looking for ways to make their investments more efficient. So, how do you actually invest in a VC? It's pretty straightforward. You can invest in new share offers directly from the VCT manager, which is how you get the 30% income tax relief. Or you can buy existing shares on the secondary market, just like you would with any other company listed on the stock exchange. However, if you buy on the secondary market, you don't get the upfront tax relief, but you do still benefit from the tax-free dividends and capital gains. Buying on the secondary market can sometimes be cheaper, as shares might trade at a discount to their net asset value. Many people choose to use a financial advisor or an investment platform to help them navigate the process and choose the right VCT for their goals. Now, we need to have a serious talk about the risks. The generous tax reliefs are there for a reason. VCTs invest in very small, earlier stage companies, and let's be honest, many new businesses fail. This makes VCTs a high-risk investment. The value of your investment can fall as well as rise, and you could get back less than you invested. Unlike money in a bank, your capital is at risk. Also, because the shares are in unlisted companies, they can be illiquid. This means they can be difficult to sell quickly compared to shares in large, well-known companies. The 5-year holding period to retain the initial tax relief also means your money is tied up for a significant amount of time. VCTs are definitely not for your emergency fund. They are a long-term investment designed for people who understand and can afford to take on the higher level of risk. So, who should consider investing in VCTs? Typically, they're suited to experienced investors with a larger portfolio who are comfortable with high-risk, long-term investments. They are particularly popular with those earning a high income who have already maxed out their ISA and pension allowances and are looking for other tax-efficient ways to invest. If you're a higher or additional rate taxpayer, the 30% tax relief is especially valuable. You should have a solid financial foundation before even thinking about VCTs. This means having other, less risky investments, a healthy pension pot, and no high-interest debt. Essentially, a VCT should only ever make up a small, speculative part of a well-diversified investment portfolio. It's not for beginners or for anyone who might need their money back in a hurry. When you're looking at different VCTs, it's crucial to do your homework. They are not all the same. Some VCTs are generalist, meaning they invest across a wide range of different sectors. Others are specialists, focusing on a specific area like technology or healthcare. The management team is also incredibly important. Look for a team with a long and successful track record of picking winning companies. Read the prospectus and the key information document. These will tell you everything about the VCT's investment strategy, the types of companies it invests in, the charges, and the risks involved. Don't just be swayed by the tax benefits. You need to be happy with the underlying investment itself. Let's imagine a quick example. Let's say Sarah is a higher rate taxpayer. She's already used her ISA allowance and is contributing well to her pension. She has an extra £20,000 she wants to invest for the long term and is comfortable with taking on more risk. She decides to invest in a VCT first. She gets an immediate income tax rebate of £6,000, which is 30% of her investment. Over the next few years, the VCT pays her tax-free dividends. After 6 years, she decides to sell her shares. The value has grown, and because it's a VCT, she pays no capital gains tax on that profit. This example shows how powerful the combination of tax reliefs can be, but remember, it also assumes the investment performs well, which is never guaranteed. It's also worth noting that the rules surrounding VCTs can and do change. Governments can alter the tax reliefs or the types of companies VCTs are allowed to invest in. That's another layer of risk to be aware of. Staying informed about any legislative changes is part of being a VCT investor. So, to sum it all up, venture capital trusts offer a unique opportunity to invest in the UK's most exciting young companies while benefiting from some incredibly generous tax breaks. The combination of 30% upfront tax relief, tax-free dividends, and no capital gains tax is a compelling proposition, particularly for experienced investors looking for tax efficiency. However, these rewards do not come without significant risk. You're investing in small, unproven businesses. Your money is locked in for at least 5 years, and you could lose your entire investment. VCTs should only be considered as part of a wider, diversified portfolio by those who can afford to take the risk. If you think VCTs might be right for you, I strongly recommend speaking to a qualified, independent financial advisor. They can help you assess your personal circumstances, your risk tolerance, and find the most suitable investment for your goals. I hope this has given you a clear and balanced overview of venture capital trusts. They're a fascinating and potentially rewarding area of the investment world, but one that must be approached with caution and knowledge. Thanks so much for watching. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe for more deep dives into the world of finance and investing. See you in the next video.